I mean, we're basically in the early stages of a very, very severe bear market. I mean, this is inevitably the consequence of rising bond yields.
This contraction of bank credit that signals a contraction in the economy, or that is reflective of or causes a drawback in the economy.
Causes it, yeah.
Causes it. We have, that introduces additional strains on many different players in that system. We had a warning 2 months ago from the ECB, which started an unlimited bond buying program, and then we just got an SEC warning on debt market liquidity. So in a normal functioning debt market, there's plenty of liquidity to cover changes as necessary to adapt to changing market conditions. But why is it so particularly likely to, or more at a high risk of creating a crisis now, if in fact we're at a liquidity low point in the debt market?
Well, it's quite simple, really. When you see interest rates rising, which is something we haven't really experienced. A proper underlying rising interest rate trend. We've had the odd, sort of change in the long-term downtrend, which went from 1980s all the way through to a year or two ago. Now we're in a different environment. And when you get rising interest rates, nobody really wants to buy bonds. So, yeah, the liquidity dries up. I mean, it dries up in the sense that buyers are no longer keen to buy bonds because they know that the bond they buy today is probably going to be worth less tomorrow. So why do it? And even pension funds, who are the staple for this, pension funds and insurance companies, they're the staple, if you like, for putting their cash flow into government bonds. I mean, they won't stop putting money into government bonds, but what they will do is they will minimize the risk from rising interest rates by going into very short maturities. They'll load up on treasury bills rather than, let's say, 30-year bonds. That's the loss of liquidity that you're going to get. And I would fully expect to see auction failures in the next year or two. It's a dead cert. I mean, we've got a situation where the yield on the 10-year US Treasury is just approaching 3.5%. It looks like it might break through that. I mean, this is part of what's going on in the market at the moment. 3.5%, yeah, but what's your inflation rate? I mean, according to CPI numbers, you're looking at over 8%. And probably going higher. So, as a serious bond portfolio manager, are you going to be keen to buy yet more US 10-year treasuries on a yield of only 3.5%? I would suggest no. I think you stand back.
Could you talk to us about what it looks like to an ordinary person and an ordinary business owner in this combined environment of debt market illiquidity and reduced exposure, reduced credit reduction by the main banks, the globally significant in banks?
GSIBs. It's not just GSIBs, it's all banks. And I think that if you like, the mainstay of every economy, which basically are the medium and small businesses, medium-sized and small businesses, I mean, that's the sort of 80% of any economy's activity. As far as they're concerned, their problem isn't so much the bond market. Their problem is getting the liquidity which they need from the banks in order to, sort of, if you like, buy raw materials in, turn it into something, and then sell it on and eventually get paid. They need that liquidity. And in many cases, they haven't got it, particularly after the complete cessation of business over COVID. So they're going to go bust. I mean, because the banks are not going to give them the credit, because the banks will want to withdraw credit as much as possible. There is one redeeming factor, I suppose, in this, and that is that a lot of the credit withdrawal will be from financial markets, if you like, Wall Street, as opposed to Main Street. Now, that's no comfort to your audience or our audience, because they are in the main, people trying to keep their capital together, and a lot of that capital is in financial assets. I mean, we're basically in the early stages of a very, very severe bear market. I mean, this is inevitably the consequence of rising bond yields. And that's going to continue. And it's going to be far worse than anything we've seen, I think, in our lifetimes. If anything, I think the potential for the fall in the stock market, well, I mean, I saw it in the 1970s. I mean, when the UK stock market lost something like 80% from top to bottom. Wall Street in between 1929 and 1932 lost 89%. That's measured by the Dow. I think we're going to be going into that sort of territory because where do these interest rate rises stop? And when I look at the inflation scene, first of all, we had COVID, and that was a one-off. Now we have energy, another one-off. And then next we've got, we've got a sort of, if you like, a number of minor problems like banking systems falling over, like central banks, in negative equity because they've loaded up on bonds. The bonds have gone down and it's wiped out their equity, and they're pretending it's not a problem. Okay, they might be able to do that for a little while, but at some stage, someone is going to notice, and that's not going to make life easy for our wonderful monetary managers. So you've got those little problems along the way. But the big problem is contracting bank credit. And when bank credit really contracts, what do governments do? Well, for a start, they lose revenue because the economy tanks. So their budget deficit rockets. The amount of pressure governments are going to come under from people in stock markets, like bond managers and all the rest of it, they're going to say, you've got to, underwrite this market. You've got to put money into this market. We've got to get interest rates down. Blah, blah, blah. And they're already talking like that, not quite in those terms. They're saying, oh, inflation is a problem. It's the recession that's the problem. So don't raise interest rates any further. That's the story they're now saying. I mean, they're completely misunderstanding the situation. So you've got that, and then you've got the problem that with the economy, the real economy tanking as well, due to contracting bank credit, what does government do? I mean, they're encouraged, according to the Keynesian theory, to stimulate the economy back into recovery, which basically means that they should spend even more, chuck more money on the fire, chuck more petrol on the fire, if you like, on the inflationary fire. So we can begin to see that having gone from, in COVID inflation, energy inflation, various other problems which are arising because of rising interest rates, we're now going to go into the final killer, if you like, for fiat currencies. And that is governments' desperate attempts to replace bank credit, which is being withdrawn from their economies in a general banking crisis, if you like. So this is not good. And it means, importantly, that interest rates won't fall. They'll continue to rise. I mean, the idea, we might look back very fondly on the days when, the Fed funds rate was only 20%. I mean, I'm not kidding. That is the potential for what is happening with fiat currencies without any sheet anchor at all. That sheet anchor was abandoned by Bretton Woods. Without that sheet anchor, there is nothing to stop the general public taking the view that they should not hold any form of currency and credit because it's going to buy less tomorrow than it buys today. So go out, buy what you need tomorrow before the price goes up. And that is the thing that really frightens the Fed. Of that, there is no doubt.